Hey everyone. Welcome back to the channel. I'm so glad you're here. If there's one ETF that I keep buying month after month, no matter what the headlines say, it's SCHD. I've been investing in the Schwab US Dividend Equity ETF for years, and even now in 2025, with so many new dividend ETFs hitting the market, I'm still adding to it every single month. Why? Because SCHD continues to do what it's always done best: deliver steady income, long-term growth, and peace of mind. In this video, I'm going to share why I'm still buying SCHD every month in 2025, the exact strategy I use, how it compares to other ETFs, and why I think SCHD remains one of the most powerful dividend ETFs ever created. Let's start with what SCHD actually is. SCHD, ticker symbol SCHD, is the Schwab US Dividend Equity ETF. It launched in 2011 and quickly became one of the top dividend ETFs in the world. It's not built to chase high yield. Instead, it focuses on quality and consistency. Here's how it works. SCHD looks for companies that have paid dividends for at least 10 years straight, and then it screens them based on four powerful factors: return on equity, which measures how efficiently a company uses its money; cash flow to debt ratio, showing financial strength; dividend yield, ensuring decent income; and dividend growth rate, because we don't just want dividends, we want them to grow. This mix filters out weak or unstable companies, leaving only those with rock-solid fundamentals. As a result, SCHD tends to hold around 100 high-quality US companies, names like PepsiCo, Broadcom Texas Instruments, Coca-Cola, and Home Depot. And historically, that quality has paid off. From its inception through 2024, SCHD delivered an average annual return of around 11%, with a dividend yield typically between 3.5% and 4%. That's powerful, especially when you factor in consistent growth and compounding over time. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. Now, let's talk about why SCHD is still relevant and thriving in 2025. We're in a new market environment. Interest rates are slowly coming down after years of tightening. Inflation has cooled, but the global economy is still finding balance. That's exactly the kind of setting where dividend growth ETFs like SCHD shine. When bond yields start to fall, investors shift back toward equity income. They want dependable dividends that grow faster than inflation. And SCHD delivers that in spades. As of 2025, SCHD's dividend yield sits around 3.7%, but the real magic is in the dividend growth rate, averaging over 12% annually for the past decade. That means even if the yield looks average now, your income doubles roughly every 6 years. And here's the key point: SCHD doesn't rely on hype sectors like tech or speculative growth. Its power comes from profitability and discipline. In 2025, that's the kind of reliability every investor needs. Now let's talk about how I personally invest in SCHD every single month. I use a simple, boring, but incredibly effective approach called dollar cost averaging, or DCA. Each month, I buy SCHD no matter what's happening in the market, whether it's up, down, or sideways. This strategy eliminates emotion from the process. I don't try to time the market, I just stay consistent. Here's how I break it down: roughly 20% of my monthly investment budget goes directly into SCHD. It's currently about 35% of my total ETF portfolio, acting as my income foundation. I complement it with a few growth ETFs, like SCHG and QQQM, for long-term upside, but SCHD remains the core. Every quarter, when the dividends come in, I reinvest them right back into SCHD. And over time, that compounding effect is powerful. Let's say you invest $500 a month in SCHD for 10 years, with an 8% average return and a 3.5% yield. After a decade, you'd have about $91,000, and your annual dividend income would be over $3,000, growing every year. That's not flashy wealth, it's stable, repeatable income growth. Now, people often ask me, why stick with SCHD when there are so many other dividend ETFs? That's a fair question, because there are some great ones out there. Let's do a quick rundown. VIG focuses on dividend growth, but offers a lower yield. DGRO, solid, balanced, but doesn't screen as tightly for quality. VIME, higher yield, but slower growth. DGRO, pays monthly and sells covered calls, but has higher fees. Each has its strengths. But SCHD hits the perfect balance between yield, growth, and cost. It has one of the lowest expense ratios in the industry, just 0.06%, and it's passively managed, which keeps turnover and taxes low. So, you're not paying for complexity, you're paying for efficiency. That's why, for me, SCHD isn't just another dividend ETF, it's the core dividend ETF. Let's clear up a few myths that people still have about SCHD. Myth number 1, SCHD is too concentrated. Yes, it only holds around 100 stocks, but that's intentional. It's focused, not risky. Those companies are the most financially sound and consistent dividend payers in the market. Myth number 2, SCHD doesn't perform well in tech-heavy markets. That's somewhat true, SCHD isn't tech-heavy. But that's the point. It balances your portfolio by giving you exposure to sectors like industrials, consumer staples, and healthcare, areas that protect you during downturns. Myth number 3, SCHD is only for retirees. Not at all. In fact, SCHD might be even better for younger investors. The dividend growth rate, combined with reinvestment and compounding, makes it a fantastic wealth-building vehicle for anyone with a long-term horizon. This isn't just about income today, it's about income tomorrow that keeps growing long after you stop working. So, why am I still buying SCHD every month in 2025? Because it checks every box that matters. Number 1, consistency. SCHD has proven it can weather market storms while still paying and growing its dividend. Number 2, quality. The companies it holds are profitable, stable, and shareholder-focused. Number 3, growth. SCHD doesn't just pay you, it pays you more over time. This ETF aligns perfectly with my long-term goal, to build a portfolio that generates steady, compounding income without me having to constantly tweak or rebalance. While other investors chase the next shiny thing, I'm happy holding something that's boring. Because boring works. So, in 2025, I'm still buying SCHD every single month, not because it's exciting, but because it's reliable. It's the foundation of my dividend strategy, and one of the few ETFs I trust to deliver results whether the market's booming or correcting. At the end of the day, real wealth isn't built overnight, it's built with patience, consistency, and conviction. If you found value in this breakdown, make sure to like, subscribe, and drop a comment below. I'd love to hear if you're still holding SCHD or if you've found another favorite dividend ETF in 2025. Thanks for watching, and as always, keep investing smart, stay consistent, and let compounding do the heavy lifting.